Good afternoon, everyone, and a early happy Thanksgiving holiday. Hope everyone has great plans and hopes the weather is going to cooperate. As we were talking, it does appear it's going to be a cool Thanksgiving day, but other than that, it should be a nice event. This afternoon, we have an agenda with 3 action items and a quarterly update of our investments, basically the program for this afternoon. So we can proceed accordingly. And with that, I'd like to call the meeting to order. The opening statement, please.
Sure. This is a regular meeting of the County Employees Retirement System Board of Trustees Investment Committee. This meeting is being broadcast via video teleconference pursuant to KRS 61826. May be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road in Frankfort, Kentucky. It is also being broadcast to the public live via Facebook. If you are speaking and not appearing by video, please identify yourself before talking. If the video or audio broadcast is interrupted, we will attempt to reestablish a connection. If the connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to a later date.
Thank you very much. And we can have the roll call, please. Sandy?
Yes. Dr. Hackbart?
Here?
Mr. Cheatham?
Here.
Mr. Fulkerson?
Here.
Mr. O'Mara?
Here.
Mr. McGraw?
Here.
Thank you.
Thank you very much. Any public comments, Sandy?
No, there were no public comments.
We have 2 sets of minutes to approve and review and reprove this afternoon. The first one is for the June 13th, 2025 meeting. The second is for the August 27th, 2025 meeting. I guess we can handle these individually. So first of all, if someone would please move to accept the minutes for the June 13th, 2025 meeting, I'd appreciate that.
Move approval.
Is there a second, please?
Second.
Any comments, corrections, or adjustments for the June 13th meeting minutes? If not, we can proceed to vote. All in favor of accepting the minutes of the June 13th, 2025 Investment Committee, please indicate by saying aye.
Aye.
Opposed? Same sign. Motion approved. Now we have would someone please make a motion for the acceptance of the August 27th, 2025 minutes?
Move approval.
Second, please.
Second.
Any comments or discussions of the August 27th meeting minutes? If not, we can proceed to vote. All in favor of accepting the minutes of the August 27th meeting, please indicate by saying aye.
Aye.
Opposed? Motion carries. Thank you very much. As indicated, we have sort of 3 topics this afternoon. The first one deals with a recommendation on specialty credit, basically provided by our staff. And that is to replace the Sparkman Capital role with the Oak Tree Capital Management, dealing with specialty credit. Specialty credit represents about 5% of our portfolio, if I recall correctly, in terms of our allocation. And this recommendation would deal with up to 20% of that allocation for specialty credit. And there's some issues to basically explain to everyone, background issues and so forth, about this recommendation. So I'd like to turn it over to Steve and staff to please provide your perspective on why you are recommending this particular adjustment in our asset allocation and the company we're using for investment in specialty credit. Steve, please.
Thank you, Dr. Hackbart. Good afternoon, everyone. As Dr. Hackbart mentioned, we are here to present an investment recommendation for the specialty credit asset class. We're excited to present this recommendation to the committee for consideration. I would like to commend Brian, Ian, and Wilshire for their hard work to finalize this recommendation. It was a lot of work. As you will see, this was a very robust and thorough search and recommendation process. And is one that we believe will benefit and add value for all of the portfolios. I would also like to note that this process and recommendation really highlights another element of staff's continuous investment process. We've had several recent investment recommendations that have included a discrete search to replace an underperforming strategy in public equities, as well as recommendations resulting from what is our continuous search process that identifies and diligences new compelling investment opportunities as they come to market to build exposures in asset classes where portfolios are underweight to their respective IPS targets. This recommendation is really a combination of both a discrete search process as well as kind of that continuous investment evaluation that staff conducts. The current public loans manager in the portfolio has been managing assets for the systems for about 15 years. And while the portfolio's performance, both from a short-term and long-term perspective, was generally in line with expectations, it didn't really rise to the level that would necessitate a search for a replacement. There wasn't significant underperformance on an absolute or a relative basis. And based on their knowledge of the market and their continuous monitoring of the universe of investment managers, both Brian and Ian determined that a formal search would be warranted and could potentially be a benefit to the systems. So that's kind of the genesis of how this search started. So it was a discrete search process, but it was driven by kind of that continuously monitoring process that investment staff does on a daily basis. And with that, I'll turn it over to Ian, Brian, and Wilshire.
Thanks, Steve. Sandy, I'll start on page 16, please. Thank you. KPPA staff and Wilshire are recommending replacing our current bank loan manager Shinkman with Oaktree Capital Management for all CERS portfolios pending successful contract negotiations. The bank loan mandate is held within the specialty credit allocation, and the recommendation is for an investment of up to 20% of each portfolio specialty credit target allocation. The recommended change keeps the bank loan asset class within portfolios while improving performance consistency and risk management. This report serves as a review of the competitive open search process in accordance with the investment policy statement, the investment procurement policy, and as the investment recommendation to the investment committee. As I mentioned, the bank loan mandate is held within a specialty credit allocation with exposure to senior secured floating rate loans. And towards the bottom of the page 16, you can see the 9/30 market values for the mandate, the percentage it represents of specialty credits, and the percentage of the overall portfolio for each plan. On the next page, please, Sandy. Thank you. The recommended structure is a separately managed account managed by Oaktree, representing up to 20% of each portfolio specialty credit allocation target, with each portfolio maintaining its current size and exposure during the transition. And for the transition, staff will work with Oaktree and Shinkman to minimize transfer costs, whether that's assets in kind transfer, cash, or a combination. The benchmark will be the Morningstar LSTA U.S. Leveraged Loan Index. In terms of management fee, Oaktree requested a redaction for the public meetings, but committee members should have a non-redacted version in front of them. Based on the initial funding size of about $670 million across both pension and insurance, the rate is extremely competitive compared to the universe data supplied by Wilshire and rates proposed by other managers in the search. And speaking of the search process, the search was started due to disappointing net performance and a desire to steer the mandate towards a pure play bank loan approach. We started with Wilshire's U.S. bank loan universe and focus list. After review and screening, we sent an RFI to candidates, including the current manager. A quantitative assessment was conducted, and I'll turn it over to Ian to explain the analytics.
Yeah, thank you, Brian. Just if you flip ahead to page 21 here, from a quantitative standpoint, our goal was to find managers that are able to deliver strong, consistent, absolute, and risk-adjusted returns, with a particular focus on the ability to outperform in down markets and limit drawdowns. So to reach our finalists, we ranked the 8 candidates based on the performance measures listed in the memo, and then weighted those results. And the final scores yielded 3 managers, which we consider to be high conviction candidates, since they demonstrated strong, consistent, absolute, and risk-adjusted performance, as well as the strong downside protection that we were looking for. So page 21 shows the returns versus the volatility of those returns across various time periods for the bank loan universe of managers. And managers that are in the upper left quadrant scored highly in our assessment because they were able to deliver above average returns with below average risk. If you go to the next page, 22, here you can see the information ratio for our 8 candidates compared to the universe. And so excluding our current top manager, the candidate pool as a whole scores in the top half, with our 3 finalists coming in the top quartile across the 3 time periods considered. And then lastly, on page 23, this page is attempting, or these charts are attempting to capture a manager's ability to deliver consistent returns across various market environments, with a particular focus on the relative performance in down markets. So ideally, you want the bubble to be top and left of the index bubble. You want it to be small relative to the other bubbles, which means that they've had lesser max drawdowns. And then you want it to be shaded blue or gray, which would indicate essentially that, that's the percentage of months that the strategy has outperformed the benchmark. And so you can see that our 3 finalists exhibit those characteristics. And I'll turn it back to Brian.
Thanks, Ian. Oh, Ian, a big gratitude. He was very instrumental in getting this across the finish line. So a big thank you to him. Sandy, I'll go back to page 17, please. Thank you. And based on that analysis, 3 finalists were selected for due diligence meetings. After team interviews and discussions, Oaktree emerged as the preferred manager based on risk discipline, performance, team structure, and cost efficiencies. Lastly, in accordance with the gating practices, staff requested Oaktree to acknowledge transparency requirements and complete a conflict of interest statement and a placement agent form. Copies of those forms are attached and will be part of the contract negotiations. No placement agents have been involved or will be compensated as a result of this recommendation. I'll pause here and let Wilshire add any comments they may have, and we'll take questions after.
Thanks, Brian. Just wanted to add from our perspective, we brought a lot of highly scored candidates to the table compared to Shankman. The candidates we brought to the table were rated slightly higher, going to Steve's point about this not being sort of an emergency replacement search due to anything major being broken, but we did feel that there were stronger candidates to consider. Preparing for this call, I was provided a few questions that either came from IC members or staff thought might be of interest to the IC. So one of them being how Wilshire viewed Oaktree's overall scoring, which, as I mentioned, is a very highly scored manager. Specifically, their due diligence, operational due diligence, where we don't provide a separate due diligence report, but it's part of our investment review. And specifically for Oaktree, we scored their procedures well above peers, ranking in the 3rd decile, and specifically noted the strength of their trading and trade architecture and compliance system, which requires 5 steps for any trade to be implemented. So multiple levels of oversight, systematic, and having actual people sign off on trades before they get implemented. So we noted that they have a strong operations and have shown a commitment to making the necessary technological investments to keep that at the cutting edge. Other than that, I just want to say, thought this was a very, very thorough process, which, again, not being an emergency replacement allows you the time to really spread out your process and do some really thorough consideration. 8 RFIs coming back and being reviewed by staff and Wilshire, and then 3 interviews, and then a further interview really points to a very thoughtful and considered process. And I think at the end of the day, it is important to point out that fee proposal that you have in front of you. When we look at bank loans as an asset class, most of these managers are shooting for 50 to 100 basis points of value add over a market cycle. So when you can cut, say 10 basis points off your fees, that's a significant portion of the value add that you're keeping instead of losing to management fees. So it doesn't sound like a big a big fee savings, but it amounts to a large percentage of the potential alpha here, and given the size of your mandates, it's hundreds of thousands of dollars in fee savings. So kudos to the team for the process and being able to negotiate a really strong fee package.
Thanks, Craig. I would add a couple of comments, taking a step back, both about the asset classes as well as the allocation. So, the specialty credit allocation, it's a bit of an artificial term. Specialty credit is not a term you typically see in the industry. We've used that as an amalgamation of what is really our private credit portfolio and our public high yield and public loan portfolio. So that allocation, which currently in the IPS is targeted at 20% for all four of the portfolios, and we view that combination as kind of the spoke and hub. We think of, as we've talked about with our high yield bonds and our high yield loan portfolios, kind of being the ballast to the overall. Those are obviously the more liquid parts of that portfolio of the specialty credit allocation. And their capacity for generating significant alpha and the amount of risk we want to take in those mandates is lower than what we would typically see on our private credit portfolio. When we think about specialty credit and when it was originally constructed, it was a combination of what was prior different asset allocation. So we had a global bond mandate, and we sought to add private credit and created this specialty credit allocation. Typically, we're looking, and Wilshire can comment here as well, but typically we've thought about it as kind of a 50-50 allocation, a 50% allocation to public markets, and whether that public markets, we typically have structured securities, high yield bonds, and levered loans, and 50% in more what we consider pure private credit. We do have some mandates that kind of have a combination of that, but that's where we typically target. We obviously have the flexibility, given the allocation and the ranges within the IPS, to shift based on our view of the market and expectations of both risk and returns for those markets. So overall, that's kind of the high level what specialty credit is, and what the recommendation here. And again, I would remind that in the IPS and the IPP, we have two types of recommendations for what we see as closed-end funds, which are typically our GP, our private assets. We have a commitment level. So we typically make a recommendation for up to X amount of dollars, a commitment to that manager or that fund. For these more public mandates that are in separately managed accounts, as Brian mentioned, we're prescribed to make the recommendation based on a percent of the asset allocation. So in this case, it's 20% of the overall specialty credit allocation, which again can change over time, right? I mean, the most recent asset allocation, we had a change in the targets and the ranges for specialty credit. So as that changes over time, this is one of the levers within that specialty credit where we can make adjustments to the overall exposure. And I would like to turn that's actually on page 20. Sorry. Yeah, that's a good view of what the current specialty credit allocation looks like. And as I mentioned, it's kind of targeting right around roughly, I would say our home base is a 50-50 allocation to private credit, and then what the more broad public liquid credit markets in high yield and levered loans. If you could turn to page 24. Thank you, Sandy. This was another, I know it's unfortunately in investments, we sometimes use terms interchangeably, and it can lead to confusion. We've used it, unfortunately, and you'll hear it used, this type of BLS, so broadly syndicated loans, which are publicly traded. So there's typically a market. We would consider them liquid, but they are less liquid than, say, public equities. And that partially has to do with their settlement process for loans is it's not the same quick settlement that you see for public equities. But these terms you'll see essentially mean the same thing. So senior loan, levered loans, floating rate notes, broadly syndicated loans, and bank loans. That's all really the same asset class, which I typically refer to it as broadly syndicated loans. Those are public loans that are traded And it's not held on a bank's balance sheet. It's not private securities. These are registered securities. And they, again, will have a more liquid tradable profile than what we consider our private credit or private debt side of the portfolio. So I just wanted to add some color there. I know that was a question that came up in some of the feedback we have, and happy to answer any questions that many might have.
Well, thank you, Steve and staff, and we'll sure appreciate the presentation. I thought it was very clear and very well presented. Just in regard to your last comments, Steve, could you clarify for the committee bank loan mandate? What exactly is meant by a bank loan mandate in this regard?
So, and that really is a manager we hire to manage a portfolio. So a mandate means we've given through our, in this case, it'll be an investment management agreement and guidelines. They will manage a portfolio of bank loans. So broadly syndicated loans, senior loans, levered loans, or floating rate notes. Those are all kind of the same instrument broadly. And so we're asking for Oaktree. Currently, that portfolio is managed by Shankman. As Brian mentioned, the recommendation is to replace Shankman with Oaktree, and that transition will occur through a combination of transfer of assets in kind and cash. The exposure will remain throughout the transition exposed to the bank loan asset class. And then Oaktree will tune the portfolio to their investment view, investment style, and their risk process. So the character of the portfolio will change, but the exposure to the asset class will remain. While we requested a 20% maximum cap on the exposure of this portfolio within the overall specialty credit allocation, I think the initial, we don't anticipate day one certainly increasing or decreasing the exposure. It will be a 1-to-1 transfer. So in essence, it's just a replacement of one manager for a different manager. And obviously they have a different investment process and investment views. So the underlying holdings of the portfolio will change over time as well.
Thank you. If I recall correctly also, Steve, I think at the present time, our commitment to specialty credit is based upon and consistent with our policy. Is that correct? And we're not really adding to our commitment to specialty credit with this transaction. We're simply making a transition from one manager to another.
Yes, that's absolutely correct. I think that the target across portfolios is 20% in specialty credit with a range of 16 to 24%. All of the portfolios, it's obviously day-to-day market valuations will change that exposure a little bit, but actual exposure, is right around 20 to 20.3% of the portfolios. So it's not anticipated to change anytime in the near future. We'll maintain that exposure exactly as it is for specialty credit.
Any other questions or comments from any members?
Mr. Chair, if I could. Thank you, Mr. Chair. I've not been shy when I didn't think things were going well. So I can't be silent when things are going extremely well. I want to say to Steve and his team and to Wilshire, in the 5 years that I've been here, this has been the best search, the best presentation, the most thoughtful approach that I've seen the office take. And Steve, I commend you and your team for doing it. You're setting a very high bar for yourselves.
Well, thank you. We appreciate that, and all the credit goes to Brian and Ian. They led this effort. They did a great job, and obviously Wilshire's contribution is much appreciated.
Any other comments or suggestions or questions?
I would be remiss if I didn't have a couple of questions.
Please, free to proceed.
And I'll begin by echoing exactly what Ed said. I think this process has been certainly one of the best that I've seen and been involved with, which has obviously been pretty limited up until this point. I do have a couple of questions, and then also, Steve, I asked this question in our last meeting over this. just for, for you to kind of explain to the board members what is meant by, T+1 versus, in this case, I think it was what, T+14, is that right?
Yes, yes. And I'm happy to, you want me to answer that first, or would you like to?
Yeah, if you don't mind, just explain that to everybody, because I think when, one of the questions that always comes up now is with regard to liquidity and access. And
Sure,
I think
sure.
putting that into context would be beneficial when we're talking about particularly specialty credit and private credit.
Yeah, across that liquidity spectrum, I think we have, it's a pretty broad range, right? If we start at cash, which is obviously the most liquid instrument, and then we move to things that are short T. So T plus means trade date plus, you sell a security, what's the date that you get the cash for the security that you sold? So we have a T+1. So if I sell it today, I get the cash in my account tomorrow. Levered loans have an extended settlement period. As you mentioned, it's typically, it can be T+14. It can be, sometimes they take a little bit longer. From a legal perspective, the day you sell, you essentially have transferred ownership of that security, that loan, to the buying party. The day you get the cash is the +14 days, the settlement date. And so that can be extended, and it's more extended because the paperwork and the processing for loans is different than we would see for a public equity exchange trading, right? You don't go to your broker and trade it like you do public equity. So it's considered less liquid only to the extent that the settlement from the day you sell to the day you get your cash is going to be an extended period relative to investment grade credit, relative to public equities. But it's not the case where, like with private credit, there's no market for those securities. Typically, you have to search for buyers, you have to search for sellers, negotiate between the two. This is a much more liquid market where there is a two-way market made on most of the instruments in this portfolio. You're able to sell them, you're able to buy them, which is one of the reasons why, we like to keep some, loans are favorable right now, both because we know the spread environment and the rate environment is favorable, but also it allows an opportunity, especially through a manager like Oaktree, that, that's the liquid opportunity of the portfolio to take advantage potentially of dislocations or to rebalance the portfolio, both raise cash or deploy new capital. So we need some element of that overall specialty credit portfolio, which is, the high yield bonds and the loans that are liquid and tradable so that we can deploy or recall capital as needed.
I appreciate you going through that, because I think you hit the key thing that I wanted to bring out. A lot of times when people hear private credit and they hear private equity, they equate the same illiquidity issues, and they are everything but similar.
Correct. Yes,
So,
very much so.
I wanted to bring that out. Now for my question. If I understood what you presented, I think it was on page maybe 19 or 18 or something, somewhere along through there, you're requesting the ability to use Oaktree for as much as 20% of the private credit mandate. Is that correct?
20% of the specialty credit allocation, which is currently 20% of the overall portfolios. Yes. So that would equate to 4%. Right?
Currently, the assets that are currently with Shankman amount to approximately 6.9%.
Across portfolios of the overall portfolio, I think that's on page 16. You'll notice it's like 1.3, 1.5, 1.4, 1.4%. And that's of the overall portfolio, which is not how the recommendation is calculated. So the recommendation here currently is, I would focus on that more middle column, percent of specialty credit allocation, 6.5, 7, 7, 7.4. In a total portfolio, correct. Yes, that's 6.9% of the overall specialty credit allocation.
So we're currently at 6.9 with Shankman. You want the ability to go as much as 20% of those assets for that particular asset class to Oak Tree. Is that correct? Is that the way you're wording it?
That is correct, yes.
So with that, my question then becomes, are there other managers that you are evaluating in the same way that you've evaluated or looked at Shankman?
Are there other managers within the existing specialty credit portfolio?
I mean, if we're going to go from 6.9, potentially go from 6.9 to 20%, those funds have to come away from somebody.
Correct. I think, and again, I would caveat that with the expectation is not, there's no plan currently to increase the allocation within this mandate. So to the exposure to public loans substantially higher. We're probably at the low end of where our exposure, given kind of that 50-50 balance, where we should be. Part of that has been, it's been a funding source within the specialty credit allocation because of its liquid nature. There's one other manager within the specialty credit overall allocation that we are in the process of reviewing their fit in the portfolio. And whether or not it's a smaller mandate, but it would, I could potentially see those assets moving to this levered loan strategy if we were to terminate that manager. So that would be an opportunity to increase. It's, as I mentioned, it's not as large for the CERS portfolios as the Shankman, the current loan portfolio, but that's one that's on the top of our list for review. It is more of a liquid strategy, so it would be fungible into the levered loan strategies should we make a recommendation and it were approved to terminate that manager.
Just to add, the ability for staff to ramp up loans on short notice with a quality manager like this allows them to position this part of the portfolio in certain interest rate environments to reduce your sensitivity to rates. Because these are floating rate instruments, they hold up better, like we saw in 2022. They weren't as affected by rising rates, so they actually benefit from the rising rates because they're able to ratchet up the income they receive. So it does give the staff more flexibility in managing the rate sensitivity of this part of the portfolio.
I agree. I don't have a problem with that at all. I just, based on, again, history, I just want to make sure that we don't negate the fact that if we are going to be abandoning a manager, that still has to come before the committee.
Yes.
So
if we were to recommend, we would make a recommendation to terminate a mandate before moving any assets into Shankman. Or sorry, into Oak Tree, into the portfolio.
Okay. All right. Thank you. That's all I have.
Any other questions? Just to clarify one more time. Right now, we have an allocation of 20% to specialty credit. Is that correct? In our asset allocation policy.
That is correct.
And we're saying now that 20% of that 20% would be allocated to this particular firm. So we're talking about
yeah, that would be the maximum. Again, that numbers here on this page on the far right, percentage of the overall portfolio, and in the middle, percent of specialty credit, I wouldn't expect to see that change in the coming months. Certainly, we don't have a plan currently to change. So if we were just to change managers, those numbers in a month would look exactly the same. Again, barring market moves.
Any other thoughts, comments, questions? If not, are we ready to vote? If so, is there someone who would like to make a motion to approve the staff recommendation to replace Shanklin Capital with Oak Tree Capital Management as presented?
So moved.
Is there a second, please?
Second.
We have a motion and second to make the transition based upon the staff's recommendation. All in favor, please indicate by saying aye. Opposed? Motion carries. Thank you, Steve, and everyone for your presentation, and very helpful to us.
Thank you very much.
Determination, and thank you for your hard work in this regard. Next item this afternoon, focusing on a recommendation to change our performance management based upon a recommendation coming from, I believe this came from our consultant, and this would be to change it to something called neutralized approach for benchmarking private equity. Who is going to make the presentation is Steve.
I will.
I'll give a brief introduction and then turn it over to Wilshire. Obviously, this is their work, and they've done a great job with this, and will be very capable of presenting. But and I know David's on the line there. You know, this is a topic that we've talked about. It seems we talk about it at every quarterly meeting, and really, it's been a very high nail, frustratingly so. And that's the gap in performance between our private equity investments and the benchmark that is currently being used, which again is a public equity benchmark plus 300 basis points on a quarterly lag. So we've done a lot of work with Wilshire, had lots of discussions. They've done a tremendous amount of work kind of looking at what the alternatives are. And this is a tough one. We've presented this a couple of times, you know, alternatives, shortcomings and benefits to different approaches. And I think we finally arrived, and Wilshire will present a recommendation to the committee. As you may be aware, the benchmark for private equity asset class, and that's the performance benchmark, the roll-up performance benchmark that is used when we compare our performance versus that benchmark, was changed in the CERS IPS in 2022. And that removed the private equity portfolio's actual investment experience and performance as the short-term asset class benchmark. Since that time, 2022, which it didn't seem very material at the time, but since then, there's been really, as we highlight every quarter, significant dispersion between the performance in the public equity markets and in private equity markets. And that's driven the majority of the overall fund performance volatility relative to its benchmark that we report on a monthly and quarterly basis. As I'm sure David will highlight, the goal of the benchmark recommendation is to neutralize that short-term volatility and the dispersions and better reflect the return opportunity available in private equity investments, while also providing additional transparency into the underlying private equity portfolio. So with that, I'll turn it over to David and Wilshire.
Steve, thanks. That's a perfect background. Can everyone hear me okay?
Yes.
Yes.
Great. And I apologize. I'm so sorry that I have no camera. I have a brand new computer that does not want to let me use the camera, and I don't know why. So apologize for that. But Steve, that was a perfect backdrop for this. And this is a common situation faced by institutional investors just like yourselves. If we go to this slide 57, which has a couple of points at the beginning, these challenges, the challenge that we have with benchmarking private markets is, first and foremost, you have to make sure that you have a way of measuring the success of that program, and we have that. And that's been conducted for, quite some time. So there's no change there. We're able to prove that your program has been successful, but that doesn't get proven in a typical performance review, as Steve used the terminology, when the private equity performance rolls up to the total fund performance. And the issue is that total fund performance relies on what is called time-weighted returns. Private market investments do not really get appropriately measured with time-weighted returns. They get appropriately measured with internal rates of return. It's just a different methodology. That methodology doesn't roll up into total fund performance. So this is the sort of conundrum that institutional investors face all the time. And what can be done about that? Just to kind of make this, sort of easy to follow, I'll go over 2 pages to the chart that is on page 59, because what do institutional investors do? They don't have a lot of options when it comes to the time, to the asset class performance being benchmarked and then rolled up into the total fund. So what do some of them do? Some of them do just what you've been doing these last few years, where you use a public weighted index. In your case, that's the Russell 3000 index, and you add a premium. In your case, that's 3%. Steve outlined it. The problem is private market investments are here for the long term. you really are measuring those most successfully over 10 and longer year periods. The public market indexes that people often use to benchmark those, as you know, trade daily, are highly volatile, and you end up with huge differences between that benchmark and your actual performance in private markets when you look at it on a time-weighted basis. A good example of that is right here in your performance report today. I believe it's the 1 year period where the difference between those two measures is 10%. So that's really huge when you apply a weighting to that and let that roll into your top level total fund performance reporting. And then what it does is it begins to lead to incorrect understandings of performance, because you, in your total fund, the impact of the private markets alone might cause your total fund relative to its benchmark to be under or over its benchmark by 1 or 2% just from that component. And that component isn't really even meaningful because it's a time-weighted return. And in private market investments, you need to use internal rates of return. So problem with what you've been doing is just what we just talked about. Also, another problem with it is it's not really an investable benchmark. There is not a way to actually invest in the U.S. equity market plus a premium in any kind of indexed way, because you're adding on a premium. So you can't just do that. The second thing that some investors use are some of these in the middle of the page. You'll see Preqin, Burgess, Refinitiv, other benchmarks that are used for private market portfolios. Those are time-weighted benchmarks. They can mathematically connect and roll up to the total fund, but they're really not good benchmarks because they also aren't investable. They're actually not indexes. Those are collections of the performance of just a broad group of private equity investors like yourself. And then in that case, you don't have anything that ties to the specific characteristics of your own portfolio. So again, not a good benchmark. So in several cases, we've adopted this neutralizing approach with clients where when you look at your total fund performance and the private equity rolls up, you let the benchmark be the same as the actual private equity performance. And all this does is neutralizes any impact it has on the relative performance of your total fund versus your total fund benchmark, so that it can't swing around by things that aren't really applicable to your performance, like what was the return of the Russell 3000 index over the last 1 year. That kind of has nothing to do with your private equity performance. So if you neutralize that, you take away that problem when it comes to the returns rolling up to the total fund. But what we will always say to our clients is, if you're going to do that, it's critical that at the same time, you are measuring the performance of the private equity program on an internal rate of return basis, and then comparing that to what's called a public market equivalent. And that is also done on an IRR basis, where you can utilize a public market benchmark, say, for example, the Russell 3000 or the S&P 500 index. You can take that benchmark and hypothetically invest every one of your cash flows from the private equity program in that benchmark on the same exact day you had those cash flows. That is the industry's most pure way of measuring the success of a private equity program. We're already doing that for you in your private equity reports. You've done that for years. And in fact, in your recent forum, we presented that. And if you recall, you'll note that you've been outperforming historically over something like 20 plus years. You've been outperforming public market investments by about 2% annualized. That's the goal. You want to be sure that you're outperforming the public market equity investments, and you want to have a way to measure that appropriately. So you're already doing that. But if we neutralize the benchmark where it rolls up to the total fund, you can eliminate that problem you have of seeing these wild swings in total fund performance that aren't really real. And it's not only, a problem. I think the problem goes beyond just your quarterly reporting, because if you think about all the places where people get a 1 second glimpse at what your total fund performance was, this could be the PPOB, or this could be the press, this could be all these articles that get out there and try to capture everyone's performance. That's a snapshot, and sometimes it'll roll into there, and then suddenly you've outperformed by 3% or you've underperformed by 3%, it makes a big news splash, and it's not even real. So the goal is to neutralize the impact of that. And so that's what we bring as a recommendation for you to consider. If we go to the next slide, just to give you a sample of what many of our clients are doing, we just put the percentages on here. 56% of them, so more than half, are doing exactly what you do today, and they're just dealing with the problem, and that's it. They're just dealing with it when it comes to the total fund performance, but it doesn't tell an appropriate story. 13% of them are using one of these other private equity benchmarks, which I sort of think makes them feel a little better because it kind of works, but it really doesn't work because it's also not reflective of your program. And then 31% of our clients have moved to adopting this neutralizing benchmark, where you get rid of that problem when it comes to total fund reporting, but you at the same time are properly measuring the success of your program with IRR calculations and PME comparisons. And the recommendation that we outlined for you to consider on the bottom of this next slide, 61, would be to do exactly that. And I think, the issue that from a governance standpoint that would be right for you would be to then let those IRR comparisons and IRR returns and PME comparisons be reported every quarter in your performance reporting. And that it's already being done for you. It's just not in your quarterly performance reporting. But as we've worked with Steve and the staff to think about how to deal with this issue, the proposal is we then include that report. That's what we do with many other clients in your quarterly reporting. So you're able to monitor your private equity program. You'll know if it is being successful, but you won't have it produce this other problem when it rolls up to your total fund performance. So that's the recommendation for you to consider, and I'm happy to take any questions about that.
Any questions of Dave?
So,
Bill?
well, just to repeat back what I think you said. So you want to take this section out so it has zero impact on the weighted report, and report it separately with an IRR basis.
That's close, Bill. We won't take it out. It will still show. Early in your performance reports, there are pages where you show the time-weighted return of all the asset classes. Private equity is in there. It will show. And then you have a benchmark for it. The difference would be the benchmark will equal the performance, and the difference would be zero.
Zero.
So
zero impact.
And that's just for where it rolls up into that total fund reporting. At the same time, in every one of those reports, we will have the appropriate IRR measure of the private equity program. So anyone looking at the materials can see that program is or is not being successful.
Sandy, if you could turn to page 99. I think this is exactly to this point what we're talking about. If you notice that private equity, which is in this case the total pensions private equity portfolio, on a one-year basis returned 8.33%. The benchmark, which is that Russell 3000 plus 3% lagged a quarter, returned 18.3%. So 10% essentially more than our actual private equity portfolio. That feeds through to up top where we see the CERS and the CERS hazardous portfolios 1-year performance relative to that benchmark. That benchmark includes that 18% for the Russell 3 plus 3%. It looks like we underperformed that benchmark by 71 and 72 basis points. Of that 71 and 72, between 120 and 150 basis points of that underperformance is specifically related to the mismatch, that 10% difference in private equity. So if we had neutralized that and said, as David mentioned, and said that private equity benchmark performance for 1 year was exactly equal to the actual investment experience of 8.33, our relative performance, so it wouldn't change the actual performance of the portfolio. It would still be 11.01 and 11.00. It would change the benchmark, and the benchmark would decline by roughly 120 or 150 basis points on a 1-year basis, which again is more realistic to how actual performance was. You hear us, and I'll actually mention in the investment review, we consider it, when we look at how did our private equity portfolio do, we look at some of those broad measures David talks about, which I agree are not great because they're not reflective of our actual portfolio and the private equity program. But we're pretty in line with generally how private equity markets performed. We're not a high nail, and we're certainly not a low nail. We haven't significantly outperformed or underperformed. But that difference, the mismatch between our actual private equity investments and that public equity benchmark, as David mentioned, can make we can look great at times. The private, when again, what you'll see is those periods where public equity was down significantly, we look like geniuses, right? We look like we did a great job. We didn't do anything. Right? It's a false equivalency that makes us show very well relative to that benchmark. In times where public equity markets have done very, very well, we look like we've underperformed. But I don't think that's actually what the portfolio has done. That underperformance reported here in this case, that 71 and 72 basis points on the 1-year basis, I think that's a little bit of a phantom. It's not actually, we really could not have invested in an instrument, as David mentions, that's would have provided the Russell 3 plus 3%. That instrument doesn't exist. That wasn't actually an investment option for us. So comparing us against that might lead to some incorrect conclusions as to whether our program has been successful or not.
Other comments, questions? Any final comments, Steve or Dave?
No, I'd just say, Steve, you really just outlined it perfectly with where the rubber hits the road. Is exactly what you talked about on this page you just went through. So, that's the issue. We've faced this all over the country with funds, and, we've often recommended this approach as a way to neutralize that.
I guess the next step, hearing no additional comments or questions, is to vote on this recommendation provided by Wilshire, working with the staff. And the recommendation would be a motion to adopt a neutralized approach for benchmarking private equity as presented. Would someone please make that motion?
I'll be happy to make that motion. This is one of those issues that I think will clear up some misgivings and with regard to our performance reporting, it'll certainly make things look more accurate.
Right. Is there a second?
Second.
Second. Have a second? Any discussion? If not, we can proceed to vote. All in favor of the recommendation to adopt a neutralized approach for benchmarking private equity as presented, please indicate by saying aye.
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 Any opposed? If not, the motion carries. Thank you, Dave, Steve.
Thank you.
Involved in
Thank you very much.
producing an issue that's been around with us for a while, but hope this is a step forward to have greater clarity and more transparency and understanding of the performance of our private equity investments. The next item is a revision to our IPS statement. It's an amendment to our IPS statement. The good hard work of Ed Owens, dealing with co-investment and continuation vehicle policy. So Ed, please, the floor is yours.
Thank you, Mr. Chairman. And this originally came before the committee in August, and I'll take full responsibility for the fact that it probably wasn't ready to be shown to you then. There were still a few questions about it. I will say that with any policy, no policy is going to cover every single contingency, but it certainly leads you and should lead you in the right direction so that you have a consistent view of what is trying to be accomplished. There is a typo here. I apologize for that. This whole change is about expedited disposition, not expedited deposition. So I've written deposition instead of disposition. But for the co-investment and the continuation vehicle, much of the conversation last time dealt with, well, how do we know when we have an expedited disposition opportunity with co-investment or continuation vehicles? The answer is we won't. There will be no expedited disposition opportunity with co-investment and continuation vehicle. And the reason for that is simple. There are 6 members of our board who are appointed by the governor, 3 members of our board who are elected by the membership, and they all deserve the opportunity to look at anything that is really substantive in the investment portfolio. So anytime we're talking about co-investments or continuation vehicles, the entirety of our board needs to get to vote on that. That shouldn't be short-circuited by me. I'm not appointed by the governor. I'm not elected by the membership or by the committee chair or the board chair. Everybody needs to vote. So what we've done with D is I'm hopeful that we've laid out the idea that there is no expedited disposition for co-investment and continuation vehicles. That Steve will gather all of the relevant information. He will give that information to me and to the committee chair, and we will, as quickly as we can, call for a special investment committee meeting and a special board meeting to deal with those issues. So in order to get to where we thought we could have an expedited disposition, we totally removed it from D and added section E, which is the fund extension policy. So there are a number of legacy private equity investments that we have where the managers come and say, hey, we'd like to extend our fund for another year for a myriad of reasons. There are 3 circumstances in which I believe we could allow the CEO, the board chair, and the committee chair to make a determination so that we wouldn't have to call for the entire investment committee or the entire board to hear it. And that is embodied in section E. And those 3 things are that there are no new funds that are being requested. Secondly, that the fees are lower than the fees that we're currently paying. Maybe it's not necessarily that they're the fees that we were paying when we first entered into the transaction, but they're lower than what we're paying today. And the third would be that the CIO would receive a written authorization from 2 of the 3, the investment committee chair, the board chair, and the CEO to have a expedited disposition of that matter. So hopefully that clears up the idea that we wanted this to be very, very narrow. It was always intended to be very narrow. So we're only talking about a change as it relates to an expedited disposition. There is no expedited disposition for co-investments or continuation vehicles, and we've laid out 3 areas that need to be satisfied for there to be a expedited disposition for a fund extension. And with that, Mr. Chair, I'll take any questions.
Ed, could you just clarify in terms of these extensions?
Yes, sir.
Is there typically a time zone associated with that? And I noticed, I didn't believe that in this draft there's any indication about the amount of time that could be extended under these provisions. Am I correct in that?
Yes. So under Section D, we're saying where you would need a expedited disposition is when there is a need to have a decision made that falls in between a regularly scheduled investment committee meeting and a regularly scheduled board meeting. So if there's a request, but it's not time sensitive, we would always take those to the committee and to the board to allow them to adjudicate it. But where there is a time sensitive nature, so that we don't have a regularly scheduled investment committee meeting or board meeting prior to the time that the manager has requested that we answer as to what our preference would be, then we would utilize, to the extent that we could, for the fund extension, the expedited disposition that's laid out here.
Bill?
Yes. Thinking back on the August conversation, we're going to make sure that when it came back to us that it had been thoroughly vetted, thoroughly reviewed by all our partners. So has that occurred?
Everybody that Wilshire has worked on this policy extensively. It has been shared with the investment office. We've gotten comments back from Wilshire and the investment office on it. Yes.
Any of those we should take into consideration in our deliberations?
I'm not sure I understand the question.
Any of the comments that they would like to share for the committee to take into consideration?
Bill, are you assuming if there were comments that were not incorporated in the revised?
Yes.
I don't know that question is directed at me or the other people on the call.
Other people on the call?
Yeah.
Yeah.
Well, I'll add some of the feedback that I provided, and Ed addressed one of my concerns, but I do think it's worthwhile to look at the language specifically. I think the co-invest and continuation are much cleaner. The one concern I have is that, as I highlighted, Ed, that I think there's maybe I don't know if it rises to a conflict potentially, but a disagreement, or at least an appearance of a disagreement between the language for co-investments in the investment procurement policy and this revised IPS. And I think that could take some fine tuning on, again, given the intent and the desires of the committee and the board, which I understand regarding deployment of new investments and approvals and ratifications. But I think that, in my opinion, only the IPP still, it states that co-investment opportunities occurring from general partners, funds, or other investment managers already contained in the CRS portfolio and previously approved by the investment committee and board may be authorized by KPPA's Director Office of Investments in amounts up to 1.5% of the CERS plan assets, considering a couple of things. So I would just ask that be considered, whether there needs to be revision to the IPP language, kind of given the desires. The other comment I had made specifically regarding the fund extension, and we talked a little bit about this back in August when this was first brought up. We're also receive a lot of requests, and we've seen those very recently. It seems like we've seen an uptick in requests from either GPs or managers, non-GP managers, that are things that are not necessarily fund extensions. We see things like changes to investment periods or transfers of interest or capital recycling periods, which I don't think necessarily fall under the very specific fund extension language. I consider those more investment administrative issues that are requests for approval from managers. And in those cases, I think I would love to see language that address those either, again, same thing with there's an expedited way to approve those, or those decisions are delegated, whatever is in the purview of the board and the investment committee. But in the absence of that, my concern is that given the other language I see in the IPS, which is all investment decisions of the CEO and or the CIO not addressed in this IPS must be ratified by the investment committee and the board of CERS, that for those investment administrative type issues that are not specifically fund extensions, have we met the objective of which I think we have or are looking to do here of minimizing the need for special called IC and board meetings to address things that maybe could be addressed in an expedited manner. The only other thing, and I didn't mention this one, Ed, that the only other thing that I would highlight is, I think to be clear on the fund extension request, we have a lot of cases where, the GP will request it. It does not get approved by investors. And I just want to make clear that does not mean that CRS investment in the fund will be realized and returned at the end date on that fund, even if the fund's not extended. Typically what we see, we've experienced with some of those legacy private equity investments, funds will continue in what's called a realization or wind up phase or different things. So even if the extension doesn't get approved, I don't want the committee to believe that means that there's a hard and fast date that we're getting our money back, our investment back. They will continue. The general partners will advocate for, they're trying to optimize the economics of the realization, and we can go on for an extended period. We have funds that are well past their final date, and they're still in wind up or realization phases. So I just wanted to make sure that the committee was aware of that.
Yeah, and Steve, if I might comment on that last part, I hear what you're saying, and we could add another 5 or 6 pages to it. I'm still not sure we would capture every single possible event that might occur. What I think we're looking to do here is to develop the roadmap where we have an idea of where we're going to start with it. And I think everything that you just said to me really can easily be resolved with a conversation. I don't know that trying to codify it all in the policy that we would be able to do that for every possible situation that might occur.
I agree. I don't think you would try to do that. I think you would, my opinion would be you add more of a generic language addressing those types of requests that is more broad as opposed to specific. So we don't want to try to address capital recycling periods request, right? It would be more investment administrative requests received from GPs. So that would be my opinion.
I understand the point that you're making, but I do believe, even though technically that administrative request might not fall neatly into a fund extension, for how we handle it in the policy, we could agree to handle that very much the same way.
Other comments, questions, discussion?
I'll just make a couple of quick comments. I think the first thing I'm sitting here asking myself, are we accomplishing or at least moving the ball down the field to what we're wanting to accomplish? As far as setting those guardrails, for lack of a better way to put it, and I think the answer to that is certainly yes. The other thing that I would say, and Steve, I take what you're saying, but you can't have a policy that addresses everything, and you can't let the idea of perfection get in the way of the better. And at this point, short of meeting every time one of these firms, decides to send some kind of request out, I think this gets us to where we want to go. I don't want to lose sight that we're talking about what 7% of our portfolio is supposedly private equity. Is that roughly right?
A little bit less, but yes.
Yeah. We seem to be wasting an awful lot of time dealing with that portion of the portfolio, and I just soon clean this up and move on. If we run into another issue that we need to address, we'll address it then.
Thank you. So it's any other comments? If not, we could proceed to vote, or we could consider this further at a future meeting. If we were to vote on this, a motion that could be accepted would be to approve the recommendation for a co-investment and continuation vehicle policy adjustment to our policy statements. Is someone would like to make a motion to accept this recommendation as the adjustment to our policy statement?
I'll certainly make the motion that we make this adjustment.
Thank you, sir. Is there a second?
Second.
Motion's been made and second to make this adjustment to our policy statement. All in favor signify by saying aye.
Aye.
Opposed? Motion carries. Recommendation is accepted, and our policy statement will be adjusted accordingly. The last item on our agenda this afternoon is an update, quarterly update, Steve, Dave, and staff. So, Steve, if you would proceed with your update of our performance for the last quarter. Thank you.
Thank you, Dr. Akbart. Appreciating the full agenda. We're already at nearly 3:15 here. I'm going to ask Wilshire to hit on the key economic and market highlights from the last quarter, and then I will cover the investment performance and allocations and leave some time to ask any questions. So, Wilshire?
Thanks, Steve. If we could start on slide 71. Many of the slides that I'm going to be talking about here we have seen in the past, but this really is designed to give a backdrop about what the investment environment looks like going forward. As you can see here, what we've got is a chart showing the 10-year Treasury yield and CPI over the last roughly 50 years. And you can see that we've got this kind of line showing a downward trend, and it's titled "This Can't Be Repeated, What's Next?" But really the takeaway here is we've had 40 years of relatively low near zero rates, most recently, with little inflation or even disinflation at certain times. And that was really a tailwind for the markets. So now that we've seen inflation kind of rear its head in the most recent coming year, last couple of years, and we've seen interest rates rise back up, that does pose a potential headwind for investments. If we move to the next slide on 72, we've seen this slide over and over again, but this is just kind of re-emphasizing the annual spend of the budget. And in no way is this a political statement, but we do have a table down in the lower left-hand corner showing over the past 4 administrations how the debt has increased. The national debt has gone from being roughly about $5 trillion. Now we're sitting at closer to $36 trillion in debt. And you can see by the blue bars at the far right-hand side that pace is ever increasing. Our debt is kind of at an unsustainable rate right now. And we are at about 120% of the total debt as a percent of GDP. If we move to the next slide. Again, looking at the monetary picture here, very unprecedented. Looking at that red line through time, you can see on the far left-hand side, we had really relatively low levels of the Fed balance sheet going from just out of the tech bubble into the GFC. And then we see the GFC, we see really the rates come down. We see that monetary kind of support from the Fed kick in, and really that if you were to draw a line, you see that red sloping line would be clearly up and to the right, and we've had really unprecedented levels of support from the Fed, and so it's really kind of a painting of a picture here of, there's been a lot of money put into the system. Rates have been near zero levels. We do see them spike, obviously, right around 2022, and we are coming down. But again, we do have a high debt level, if you will, here, coupled with higher interest rates. And if we move to the next slide 70, actually, let's go to slide 76, Sandy. It kind of leads to, if you were to look at all of the asset classes that we typically present to clients in an asset liability study, and we've really bifurcated those out into two groups here. And the bottom group are assets with no or negative sensitivity to inflation. And any portfolio that has invested in these asset classes over the past 20, 30, 40 years that we saw during that time period has done pretty good. And we really kind of feel in a lot of the conversations that we're having with clients right now is that with inflation being a real kind of risk or concern out there for us, that those top asset classes, which are what we tend to be calling real assets, they do provide utility during much of the time when you do have rising inflation. So we feel like this is a portion of the portfolio that is underweighted in many institutional portfolios, and it's an area of focus for us in the future. If we go to slide 77, this is an interesting chart. You've heard a lot potentially in the news about monetary debasement, and what we're showing here is the growth, if you will, of the S&P and the NASDAQ. If you look at that nominal on the right-hand side, we all know that the S&P 500 has done phenomenally well over the past handful of years. But we wanted to show that in comparison to some other measures in excess return form. And you can see as you go versus CPI, while equity markets have outpaced CPI, as we move down to other assets, gold, and in this case also Bitcoin, we show that the equity markets have not actually kept up with some of these other real assets out there. Now, these are just two examples, but it just goes to show that when you look at equity markets versus potential other asset classes, they haven't kept up with the growth of some of these real assets. Specifically, gold, we know, has had a remarkable run up over the past couple of years, and this is an area that we've seen gold give a little bit of some of that return back in the last month or so, but it's really remarkable when you know, and it's been on the front page, how well S&P 500 has done, and you compare that to gold, and it's actually a negative excess return. If we go to slide 78, this is the kind of the picture of what we're looking at in the future here is more easing coming from the Fed. And what is priced in right now, if we were to go back just a month or two ago, there was about a 90% probability that we were going to see a cut in December. And just a couple of weeks ago, that had dropped down to a 50-50 chance. And as of today or end of last week, we're sitting at about an 85% chance of seeing the Fed make another cut in December. And this kind of tells you, if you look at all the different colored lines, what the probability or what the chances are of seeing different cuts throughout the course of next year. But the backdrop here is that the Fed is in an easing cycle right now. We do expect that there will be a cut in December and multiple cuts likely next year. So there will be a lower Fed funds rate headed into 2026, and that hopefully can offset some of the headwinds that I've already mentioned in prior slides. If we go to slide 80, coming out of the federal government shutdown, we did not get September job reports until most recently, where September jobs were up about 119,000 for the non-farm payroll. But that was mixed a little bit with unemployment ticking up at 4.4%. And there's a little more to be, I think, kind of waged through here as we get more information maybe in November and December, because we probably have a little bit of an AI push and pull here as well. As companies are seeing the benefits and productivity from AI, that could be leading to a little bit of the unemployment tick up that we're seeing. But this is, kind of a backdrop of why the Fed potentially is starting to ease more and more. We've all seen Trump put a lot of pressure on Chair Powell to lower the rates, but this is also a good picture as to a slowing economy. The labor picture does seem to be a little stretched right now. So we, see the reasoning here, if you will, why the Fed would continue to ease rates. And then lastly, if we go to slide 82, when we look at the ISM prices indexes versus the CPI, you can see that there is a very strong correlation between these two lines. And we have two areas highlighted here where in 2020, you saw ISM prices paid going up, and we did have CPI kind of go lock and step there. Most recently, we have seen ISM prices move up a little bit. Inflation looks to be relatively under control right now, but this is just a kind of telltale point, because usually, generally speaking, when you have higher inflation, you do need to raise rates. And so there is going to be a little bit of this push and pull scenario here. If we do see inflation coming, how will that impact the ability for the Fed to continue cutting rates? So it's something that we continue to monitor. Steve, with that, I will turn it back over to you to cover the performance of the fund.
Thank you. Sorry.
Bruce, before you turn it over,
Sure.
Appreciate the commentary with regard to what your future economic outlook is. I think the important question is where do we need to be focusing on as far as tweaking our current, not necessarily our asset allocation as much as what do we need to be overweighting and underweighting within the asset allocation at this point, based on what you're seeing? Are you telling us we need to be looking at more real assets? Are we looking at, do we need to be looking more at global equity? Where do we need to be? Everybody need to be focusing their attention.
Yeah, I think that's a great question. And generally, institutional investors will do an asset allocation every 3 to 5 years. I think it's been about a year and a half, maybe just over that, since the last time we did the study. It took us a little while to get that actually approved. But your targets were set about 12 to 18 months ago. If we were to look,
talking about changing our asset allocation,
yeah.
We talked about private credit earlier. We're roughly at around 20%, but we've got the ability to be as little as 16 and as much as 24.
Sure.
Do we need to be moving, towards that 24, for example?
And I would say, generally speaking, if you were to look at investment strategy committee minutes for our for Wilshire's ISC, we're really preaching because we're in a time of uncertainty right now. So we're not making huge tactical shifts one way or another into any asset class, to be completely honest. We have had some tilts with some of our discretionary portfolios. We quite frankly have moved to a more neutral stance because of that uncertain nature of the economy right now. So to answer your question very bluntly, Mr. Cheatham, we're really stressing sticking to your strategic policy right now. If we were to look at doing another asset liability study here, which we will in the next 12 to 18 months, depending on where the markets are, I mean, right now, our long-term equity market assumption is not a very attractive number right now. We have a negative equity risk premium embedded in that, where it's about 85 basis points, I believe, as of 9/30 negative. Normally, you would expect a 2 to 3% equity premium of equity markets over bonds. And this is just US equity markets I'm talking about. But right now, largely because of the valuations in the US equity market, those spreads have been really, really compressed, and they have moved negative for some time.
Well, I don't disagree. I guess where my question is, Steve and his folks are certainly on top of what they're doing with the portfolio. From our perspective, I think at this stage of things, we need to be focused on risk management as much as performance. So I'd be interested the next time we get together, your all's thoughts specifically with regard to, what can we do to either, slightly de-risk tactically and still not impact return.
Sure, we'd be happy to put some slides together on that.
Well, and Lyle, I would just add from our perspective as staff, I would agree with Wilshire in this the proposition of taking overweighted bets, significant overweighted bets. It does not feel like the right environment for that. What you've seen us do is you've seen significant progress in the real return, which I think we viewed. Our top asset classes when we first were talking about the new asset allocation were specialty credit and real return. You've seen most of the recommendations, or a significant amount of the recommendations we've made over the last 18 months have been in the real return asset class and moving. We've closed that gap. It was more than, close to 4%. Now we're, less 50 basis points away from target in the real return, and we still have capital being called in commitments that we've made. I think the current environment too, I think it's hard not to argue that public equities, especially U.S. public equities, are overextended. I think that's, to Chris's point, if you look at forward expectations for performance and returns, they're depressed relative to what we see from historical standards, and that partially has to do with that starting point bias. There's a lot of potential headwinds. De-risking the portfolio is always top of mind for us. I think we look at where we are in core fixed income. That's our true ballast. If we look back at the ZIRP world, it didn't offer that when rates were at zero. There was no ballast to it. It does now. We took an opportunity. We had a short duration profile in our core portfolio. We extended. We're relatively neutral on a duration perspective now. I think that feels like the right place to be given kind of the uncertainty with rates. I'll talk a little bit too about pricing and expectations for the Fed. But if anything, I think we overweight, kind of the fixed income complex generally because it offers a lot of yield currently, especially given the risks that we see and what our assumed rates of return are. We've maintained kind of that relative underweight in private equity. I think that's benefited performance overall. We have seen some more attractive opportunities. We just recently had a private equity manager approved, a new mandate approved. So we're willing to allocate where we see value there. But I think that in real estate are still two asset classes where we're not super bullied up on as far as deploying new capital. We're being opportunistic where we can, but it's a difficult environment to say where we should be. I think Joe's on here from a public equity perspective, which obviously is one of the largest exposures in the portfolio from an overweight relative U.S., non-U.S. That's one of the levers we pull. We've had a modest overweight to non-U.S. equities that hurt this quarter, as I'll talk about here in a minute. But I still think that the value proposition we see there in the return expectations is we've trimmed that position a little bit, but I think that we still think that there's probably more value in the international side than in the U.S. side. So that's where you'll see us tilting the portfolios. Joe, if you want to add some color there, please feel free.
Yeah, you're right. From a valuation perspective, as Chris mentioned, the U.S. is stretched. We've got a modest tilt towards non-U.S. It looks to be a better bang for your buck, what you're getting for your invested dollar. In the U.S., growth has been running strong. The opposite's been the case in the non-U.S. Smaller cap stuff from a valuation looks a lot better than larger cap stuff. It's really influenced by the AI stuff. Anything that's not touching AI is just not being rewarded by the market. So there's plenty of companies out there that are fundamentally performing like they should. The earnings are there. The market just doesn't care that much. Lower quality stuff is being rewarded. We have some aggressive stuff within our portfolio, but we don't typically buy low quality stuff. And so it's been a real headwind and frustrating to watch some of these companies that frankly don't even have earnings. They're negative earners, but they're the ones that have high momentum in the market. And it's hard to keep up with them when the market doesn't care that the quality stuff is actually performing the way it should. If we do have any kind of market downturn, our portfolio is probably going to hold up fairly well versus the market. And so, you know, we've taken a few tilts here and there, but not dramatic. Like, you know, the volatility last week, the markets looked horrible. The last couple of days, including today, they've looked great. So it's been a tough time to know where to really be. So
It was mentioned that we're in a particular period of uncertainty. It seems to me that that's almost continuous. We always have significant uncertainty. I'm not sure if it's any greater or less than it's been 5 years ago or 10 years ago. I was your assessment of the uncertainty issues. Certainly,
the frequency of the larger tangential events are occurring at a more high frequency. There was some studies that a few of our managers have done and shared with me, and those big market moving events seem to be happening more frequently, geopolitical wise type of things. So the volatility has been increasing. So it's been more difficult where fundamentals don't always seem to matter, and that's hard for fundamental investors to deal with. So.
And I'll just add a quick comment to that, is that every market environment is going to present its own unique challenges. It does not opportunity can arise out of challenges, but you don't need to take a position versus your policy in every market environment. There is not always an opportunity out there that is as obvious as, say, maybe high yield was coming out of the GFC. That when spreads blew out so wide, I think there were a lot of people that saw that that was a really attractive opportunity. Wilshire's capital market assumption went up quite a bit during that time, and it just so happened that all of that return was really realized in like a 2 to 3 quarter span. If you didn't have a very nimble investment process, you were not able to take advantage of that. But those types of opportunities do not come around once a year or twice a year. They come around maybe once or twice a decade. So in this time of uncertainty, we are not seeing any current layups or softballs, if you will, that, you know, really we would be pushing you into tactical weights. We are very neutral to our own kind of pair trades, if you will, right now.
I call them fat pitches, Chris.
There you go. And I always liked those too. Problem is, you swing too hard at them and you pop them up and you feel like a doofus when it happens.
Yeah.
Throw out your rotator cuff. That's bad.
Steve, would you like to proceed with your report?
Sure. I will try to be as brief as possible here. I know we've touched on a lot. Sandy, if we go to page 99 quickly, please. Thank you. Consistent with the overall positive market backdrop, the portfolios produced strong positive performance during the quarter, first quarter of the new fiscal year. The CRS pension composite produced a return of 4.29% for the quarter, while the CRS insurance composite returned 4.19%, both underperforming the blended benchmark's return of 5.20%. At the portfolio level, the CRS pension portfolio returned 4.30%. CRS hazardous pension portfolio returned 4.27%, while the two insurance portfolios produced returns of 4.21% and 4.14%. Drilling into those top-line performance numbers, the two issues we've already talked about, public equity and private equity, were the largest contributors to overall underperformance relative to the benchmark. As Joe mentioned, the overall global public equity portfolio underperformed the benchmark by almost 100 basis points, as both the U.S. and non-U.S. segments of the portfolio underperformed their individual benchmarks. This underperformance contributed between 49 and 51 basis points of the overall underperformance at the individual portfolio level. Our modest non-U.S. equity tilt detracted from relative performance as these markets underperformed their U.S. counterparts. Stock selection, particularly in the international markets, hurt performance as the beta-driven risk-on environment proved difficult for active managers. The portfolio's quality bias was also a headwind during the quarter, as market performance was driven by lower quality, higher volatility names. In the private equity portfolio, underperformance relative to its public equity benchmark, as we mentioned, on the pension side was 838 basis points during the quarter, and on the insurance portfolio was over 1,000 basis points. This underperformance contributed between 50 and 71 basis points of the overall underperformance at that individual portfolio level. We talked about that. We just adopted we hope is going to be a solution to that mismatch problem. As I mentioned during that discussion, the private equity portfolio's return for the quarter of 3.3% was generally in line with the broad private equity market's reported return of 3.1%. And that was according to the MSCI Private Capital Benchmark Report. So again, we're not out of line. Our portfolio is not significantly underperforming or outperforming generally the private equity market. We're relatively in line, but significantly underperforming that public equity benchmark. Performance for the quarter did benefit from the overweight to public equities, the underweight to real return, and the outperformance of the specialty credit portfolio. Specifically in that specialty credit portfolio, it produced a return of 2.50% for the quarter, which outperformed the custom benchmark by 35 basis points. And over the last 12 months, that specialty credit portfolio has outperformed its benchmark by 203 basis points with a return of 9.24% compared to the benchmark's return of 7.21%. A couple of other performance highlights. In the real estate portfolio, the three open-ended core real estate strategies, which represent roughly 2/3 of that overall real estate exposure, all produced positive returns during the quarter and have outpaced the ODCE benchmark over the last 1, 3, and 5-year periods. So good performance within the real estates in a very tough environment. The real return portfolio continued to perform well. It gained 3.7% for the quarter versus 1.5% for the benchmark, and it's returned 12.5% for the past 12 months compared to the benchmark's 5.9% return. So very strong performance in the overall real return portfolio. As we know, the portfolio's MLP manager is almost is a major position within that real return portfolio and is up almost 20% over the past year and more than 25% annualized over the past 3 and 5-year periods. I would note the portfolio's railcar leasing manager returned 4.2% for the first half of 2025, and it called the rest of KPPA's commitment at the end of the third quarter and is now fully funded. The portfolio's inland marine transportation manager returned 2.3% for the quarter and 8.3% last. And remainder of KPPA's original 3 commitment and the additional in August. So we're fully, our capital has been fully called there. Page 101, please, Sandy. Thank you. The internal portfolios all performed in line with expectations and objectives during the quarter. The majority of these assets, I'll remind you, are passively managed and intended to replicate the return and risk of public indices, providing inexpensive beta exposure to what we view as the more efficient parts of the market while providing staff flexibility in rebalancing the overall portfolio asset and risk allocations. Additionally, staff manages a number of proxy portfolios to gain exposure to assets with similar risk, return, and economic characteristics. And these serve as transitional positions for less liquid asset classes as committed capital is called by manager and as staff sources new investment opportunities. Those get unwound as that new capital is called and committed. Page 120. Thank you. This report shows the individual mandates and accounts across the full portfolio with a comparison to the respective performance benchmark for each account and will be included in our monthly and quarterly reporting packages going forward. While this information was available in other sections of the reporting, we wanted to include it as its own separate report to increase transparency and efficiency of the oversight for trustees. So that's a good report to take a look at how individual managers are doing relative to their respective performance benchmark, which may not necessarily be the performance benchmark for the overall asset class. So that's a good one to review. Page 126, please. Thank you. On these attribution pages, I just wanted to highlight a couple of things. The graphic on the bottom right in orange, which shows the outsized impact that we've talked about for the private equity relative to benchmark, over the last quarter as well as over the last 12 months. And on page 130, you'll also note that the graphic in the green on the bottom middle of the page, which depicts the positive performance impact from the asset allocation tilts in the portfolio, which is the underweights and overweights implemented relative to the IPS asset class targets. That's where we'll see, as we talked about, we have a modest overweight to public equities, we have an underweight to private equity, and those are kind of the depiction of the impact of those tilts on overall performance. Page 134. I always mention this is almost some of my favorite graphs and charts. Really show the efficiency of the portfolios, and happy to report again that all of the pension and insurance portfolios have produced exceptional top decile risk-adjusted performance over the reported 1, 3, and 5-year time periods, and that's based on Wilshire's All Public Plans universe. As the graphs show, the portfolios all have sharp ratios in the top 10% and in most cases in the top 5% of Wilshire's peer universe over all of the reported time periods. And again, I emphasize this. We believe this is really an important metric, as the asset allocation guidelines provided by the investment committee and the board really determine and specify the risk parameters and constraints under which staff constructs and manages the portfolios. And these risk-adjusted return measures demonstrate the efficiency of the portfolio and the efficiency of the portfolio management. Page 150. Sorry, was there a question? If not, we can go to page 156. I apologize. I'm rushing through this here, trying to be as brief as possible. This is our standard report for capital calls and distributions. And as I noted last quarter, we've made some enhancements to it. And that enhancement is really, it shows quarterly activity and commitment levels by asset class, which we think provides that greater level of transparency. And I would note, as I mentioned earlier, during the quarter, $128 million was called for the real return investments in the pension portfolios, and $38 million was called for the insurance portfolio. So a lot of money has been put to work in that real return asset class. Staff has done a great job of sourcing new investment opportunities, and we're very supportive of managers calling them as they find compelling opportunities to deploy that capital. Page 180, please. The investment budget that was just presented at the Finance Committee, I'll walk through it again. I know several of you were on that committee, but through the first quarter of the new fiscal year, overall investment expenses were running below the amount budgeted for the full fiscal year, with a total of just $941,000 spent during the quarter, which represents only 8% of the amount budgeted for the full fiscal year. Looking into the different categories here on the budget, consulting services were in line with budget, with 21% of the annual budget spent during the quarter. And obviously the high nail here is always the difficult legal and auditing services category. Only 2% of the amount budgeted for the year was spent during the first quarter. I'll defer any questions there to Michael and Vicki, but I think we anticipate those expenses to come up over the balance of the fiscal year. In the contractual services category, 11% of the budget was spent. But I would note there's a few timing items, and one is very significant. A quarterly invoice for the BNY custody fees was not paid during the quarter, but was paid in October. And that was a total of $800,000 across the pension and insurance trust. Also, the Giant Gervia fee of $60,000 was just recently paid. And I would note those are the tax and accounting services for investments in our international public equity portfolio, and specifically investments in India. Page 183. Thank you. At the total pension level, investment fees and expenses declined by $4.4 million, or 10% from the first quarter of the prior fiscal year. And while the total fees for most asset classes increased modestly as a function of the increase in market values, the overall decrease was driven by the significant drop in specialty credit performance and miscellaneous expenses, which decreased by $5.4 million, or 27%, as the asset class performance and the interest expenses of those investments moderated from the prior year. As we always note, staff continuously evaluates the reasonability of manager fee levels across mandates and works with existing managers to ensure the systems are paying the lowest possible fees based on the investment strategies and account sizes. And I would note at the total pension level on a weighted basis, the overall investment management fees are approximately 30 basis points on an annualized basis across the entire portfolio. And the combined CRS portfolio is in line with this broader overall pension number with a weighted average management fee rate of 29.6 basis points. Within those asset classes, core fixed income, as usual, has the lowest management fee, which is 6.4 basis points on a weighted basis. But that also accounts for the assets that are managed internally, while the real return portfolio currently has the most expensive weighted management fee rate of approximately 79 basis points. I would note that the performance for October is not finalized, but the portfolios are tracking to produce a little over 1% for the month in very choppy markets. And this should bring fiscal year-to-date performance to about 5.5%. Wilshire touched on this, but I wanted to comment as well that views on a possible rate cut at the December 10th FOMC meeting have been really volatile over the last 6 or 7 weeks. As Chris noted, that we saw the market pricing in a pretty wide range of potential outcomes from nearly a coin flip as to whether they would cut to, I think we're up to, as you mentioned, I see pricing is currently at around 86% for a move in December. We think that likelihood is somewhat less certain than that currently priced in, but we think the odds do favor a reduction in policy rate, although it's likely to be a closer decision when it's all said and done, which may mean that the path of rates is maybe a little less decidedly leaning towards further additional cuts or significant further cuts. The recent change in Fed speak supporting further easing has really helped to reverse that recent sharp sell-off in equities that we saw in risk assets more broadly, and that was driven by the dwindling hopes for a rate cut. So we see how influential that expectation of rate cuts has been on both expectations as well as current market pricing for risk assets. The most recent survey of Wall Street investment strategists' year-end targets for the S&P 500 is very optimistic that the bull market for global stocks will continue in 2026. I would note that the greatest risk they see to this scenario is a resumption of inflation that brings the Fed hikes in its wake. That is far more alarming to bulls than a stall in the AI capex buildup that completely swamped the risk of resumed trade war or political defeat for the current president in the midterm elections. So that's the top of investors' minds, is the path of inflation and whether that's has really been subdued or we'll see an uptick into 2026. I think that level of optimism, as we talked about briefly, is a little surprising, kind of given that almost universal belief that U.S. stocks are expensive at current levels. And there is, growing fear or certainly talk that we are in a potential bubble. And much of that optimism really rests on the confidence that corporate earnings will continue to increase, which we think will be a struggle. And as a staff, we're a little less optimistic than the market currently appears. We do believe that strong fundamentals have supported equities, but stretched valuations and narrow leadership really create more of a fragile environment. Fixed income investors have to adapt to a new inflation regime. And while inflation currently seems contained, as Wilshire mentioned, we believe the tail risk does persist. Against this backdrop, we maintain our investment discipline, avoid the trap of investing to fill buckets, and instead look for durable, well-supported investment themes and strategies and managers that we think have a high probability of navigating market gyrations while providing opportunities to take advantage of potential dislocations. As we mentioned, those don't come along often, but we both need to be ready and able to take advantage of any dislocations we see. I think the last substantial one we saw was during COVID, where we deployed a significant amount into public equities, which benefited the portfolio. Those fat pitched trades don't come along often, but we need to have the liquidity in the portfolio and the dexterity to take advantage of them when they do. With that, I'll pause for any questions.
Any questions of Steve? Thank you for your presentation, both Wilshire. Thank you for all your information you provided. Steve, a very comprehensive report. We appreciate that. Feel a little bit better of uncertainty, but it seems like uncertainty is something we always have to deal with, and we just have to deal with it. With that, I think we've had a good meeting this afternoon. We've gone through 3 major issues and successfully dealt with those and passed those recommendations. And with that, again, I wish you all a happy Thanksgiving and a nice break. And with that, our meeting is adjourned.
Happy Thanksgiving.